Hello and welcome. My name is Richard Hutton, and this is the first episode of me detailing my investment journey. Now, a little about my background. I am 25 years old and I have recently retired, that is, reached financial freedom through investing. I started studying and investing in the stock market at age 14. I had some nice early successes and then some big losses. So I really put my head down and studied, psychology, different strategies, even derivatives and stuff like that. After many years, I finally reached a breakthrough. So like I acquired sufficient knowledge and experience that I made it. And in about less than 2 years, I made enough money that basically I never have to work again. And that I think it's a good definition of rich. Like, when is a person rich? Is it when they have $1 million, $1 billion? Well, if a person has enough money that they never have to work again, that's a pretty good definition, right? So I quit my job and now I just take out a few percentages of my account each year to live on, while the rest of my money keeps growing. Now, I made most of my money through a single investment, Tesla. Now, this was not the YOLO calls, so some people might call that lucky, but I did do a bunch of research. I understood the competitive advantage of the company, and it so happened that in 2020 the stock went up enormously. But either way, I thought, okay, I will hold Tesla stock until Tesla becomes a mature company. So until the growth rate of its sales will slow down to below, let's say, 15% per year, right? But that could be many years in the future. Still, I kind of stumbled upon this investment opportunity by chance, but I wanted to create a strategy, like with clear rules of how to find great companies, right? And I believe I have. I call this strategy the Exponential Fund. That is what I want to share with you. So instead of theorizing about it, let me just show you right away. All right, so you go to finviz.com, then click Screener, then go to Fundamental, and then go to Sales Growth past 5 years and click High above 25%. Okay, then Sort by Market Cap from high to low, so you click that twice, and voila. Now this, just in my opinion, is an absolute gold mine. These are the 20 biggest companies that have been growing their sales by at least 25% per year for the last 5 years. The strategy says the following: put an equal amount in each stock, so 5% of your money in each stock, and rebalance regularly. Now, what does that mean? Let's say you put 5% of your money in Amazon, 5% in Facebook, and so on, and you wait a month. And let's say Amazon goes up by 10% and Facebook goes down by 5%. Well, now Amazon is not 5% of your portfolio anymore, but it's more. Maybe it's 5.5% or something. And Facebook is not 5% of your portfolio, but less, maybe 4.8% or something. So what you do is you sell some Amazon stock to get it back down to 5%. And with that money, you buy Facebook to get it up to 5%, right? And what have you done with this? You systematically buy more of a stock when it's going down and then sell some when it's going up. Buy low, sell high. Right? But the thing is, you don't need to predict what the stock will do, right? It's brilliant. You can do this rebalancing daily, weekly, monthly, quarterly, yearly, whatever. Right now, I do it weekly. That seems about right. And once a year, you check back on this website to see if the list changed, right? So maybe some companies slowed down their sales growth, so they dropped off the list altogether. Maybe other companies which are lower in the list, right? So let's say Twilio. Maybe Twilio went up a lot in stock price, so now it's in the top 20, and another company was dropped off the list. Right? So you'd simply replace any stocks that dropped off the list with new ones. Right? It's very simple. Now, I want to delve deeper into explaining how I got to this strategy, because it really, for me to explain how to execute the strategy, it literally takes me 2-3 minutes. But that is the tip of the iceberg after a lot of thought went to it. So to distill all of my learnings, I thought, okay, I want to write down all the principles that I learned that led me to make the Tesla investment, as well as create this exponential fund, right? And I came up with 10 bullet points. So let's go through them. Number 1, becoming rich is simple. The reason so few succeed is lack of patience. Last year, I had this spontaneous thought, like, back when I started investing in 2010, I read a book called Rule Number 1, How to Invest in Stocks by Phil Down. Highly recommend it. Great book. It basically outlined a strategy which is quite similar to what Warren Buffett does, with some variations. So how to find a great company, how to analyze it, when to buy, when to sell, and so on. I was 14 at the time, and after reading the book, I showed my dad, like, Dad, look, it's fucking great strategy. So I did a bunch of research. I found a few companies which matched the criteria that the book laid out. Those companies were Apple, Amazon, Google, eBay. Now, here's the trick. The book didn't say buy and hold. The book showed a strategy of trend following. So basically, short-term trading, trades which could last anywhere from a few days to a few weeks, right, to catch the uptrends. And I did that, and it did work at first. Now, the market overall was going up as well, so that was beneficial. But it didn't talk too much about risk management or psychology. And because I had success after success, I kept betting more and more and more money, and then borrowing money from the broker, so leverage, and then more and more and more and more. Until at some point, I think it was 2012, I was leveraged 10 to 1 in a single stock. That's fucking retarded. But that's what happens when a 16-year-old starts making $9,000 a day. So, of course, I lost a bunch of money. Not everything. Overall, I was still like flat or something. But it was traumatic. Now, last year, I just had this thought. What if I just bought and hold those 4 stocks? What comes next will shock you. The returns of these stocks were anywhere from 500% to 2000%. And I was like, I'm a fucking idiot. I was bullshitting myself with all this trend following short term trading bullshit. That if I was just fucking patient, like I literally had the stocks which went up a lot. Now, I will not do this mistake again. I am patient with Tesla. But that's the point, right? I read Market Wizards, right, the book, where it talked about a bunch of great traders and investors which made obscene returns, like 10% a month, like 80% a year, like fucking crazy amounts. Now, that is possible. I am not denying it, but it's not easy. It's very hard, right? But if you were to aim for 15, 20, 25%, that actually, like technically what you need to do to achieve those returns is very simple. But people usually don't have the patience to wait 10 years to grow their account 10x, even though that's a very good return, and much more than the S&P 500 would return. So that's the first thing, patience. Number two, a stock is a piece of a business. Now, this is not new information. Like all of these 10 bullet points in and of themselves are like simple, and you probably heard them before. But just like a great chef would take a bunch of ordinary ingredients and he would mix them up in a new way, the same is this. Take a bunch of simple ideas, but the way you put them together, something new comes out, right? So a stock is a piece of a business. What I'm referring to is I do fundamental analysis, and that's it. That is literally it. That I only use fundamental analysis to guide my decision making. Right? I do not care about technical analysis at all. I do not care about charts. Right? Like when I showed you the list of 20 stocks, I said put 5% of your money in each. This is not investment advice. It's just my opinion. Like this is entertainment. This is what I do. Like I literally apply this strategy. So I put 5% of my money in each. I don't care what the chart is doing, okay? Because I do rebalancing. That's how I get an edge, an extra edge. Right? So, fundamental analysis. Number three. In the short term, the price of a stock is based on mob psychology. In the long term, the price of a stock is based on the financial performance of the company. Right? Simple enough. So, it is possible to make money with short-term trading. I'm not denying that. However, even the best traders usually have a win rate of about 50%. Right? The reason that they make money is because when they win more than when they lose. Right? So maybe their winners are twice as large as their losers, something like that. However, number four, in the short term, the price of a stock is unpredictable. In the long term, a great company follows a predictable S-curve growth trajectory, right? And this is a great insight, right? So the really fast-growing companies, disruptive ones, just like Apple was from 2010 to now. If you were to Google, and please do so now, Google yearly iPhone sales, right, is the perfect description of the S-curve growth trajectory, right? In the first couple of years, sales were very low. It was like a new thing. People were getting used to it. But after like a few years, people realized, oh shit, this is great. And sales growth fucking exploded. And after a while, pretty much everyone who wanted to get an iPhone got one. So the sales growth slowed down, right? This is very predictable, right? Or for example, Tesla, right? The most costly part of an electric car is the battery, right? And the battery is on a predictable cost decline curve, right? So I learned from ARK Invest this idea of the Wright's law. So with every cumulative doubling in production capacity, costs decline by a certain amount, right? And as costs go down, the demand goes up exponentially. Right? So I heard something like when the Tesla first built a Roadster, just the battery was like $100,000, something like that, like enormous. Now with the Model 3, it's like $7,000, like enormous decline. And of course, if you just Google Tesla yearly sales, same thing, predictable S curve. Right? In the short term, the stock price will go up and down, who knows what the fuck. But in the long term, let me ask you this. If you buy a stock today, and in 5 years, that company triples its sales, is it likely that the stock will be higher? Yes, it's likely. Not guaranteed, but highly likely. And here's the thing. You deal with probabilities anyway. Right? There's this mistake that the mind does, thinking that if you do more research, you increase the chance that the stock will go up. Well, let me tell you something. If two people buy Amazon stock and Amazon stock doubles, both people will have double their investments. Even though, let's say, the first person did 10 hours of research in Amazon and the second person did 1,000 hours of research on Amazon. Regardless of how many hours of research you've done, if you buy a stock and it goes up, you make money, right? So, number 5. The most important factor in business success is high sales. The most important factor in business failure is low sales. Who can argue, right? Number 6. A large company fundamentally has a smaller probability of going bankrupt than a small company. Again, this is common sense. The idea is so simple that when I say it, you're like, of course. I don't need to show you research papers to back this up. It's self-evident. It's so obvious, like me saying it's better to be healthy than unhealthy. Of course. But here's the thing. How do you apply this to investing? This strategy, the Exponential Fund, says this. Invest long-term in big companies that grow fast. That's it. Now, if you have a stock and you want to analyze it to decide, is this a good investment? The amount of information about this stock is so staggeringly enormous that it would take you like months, if not years, to study everything. And by then it's too late, right? So we can agree that you can't study everything about a company, right? It's just not enough time. So if you can't study everything, you need to select what you study. Well, how do you select? What is the most critical pieces of information that you need to know to make an investment decision? Going one step further, what is the minimum amount of information you need to decide to invest and to have an edge legitimately, right? Let me give you an example. Let's say there's a company X. I'm not even going to give you the name. This company last year had sales of $31 billion. Just from this, what can we infer? Well, we know that out of 100 companies, like a bunch of companies started this year, 10 years from now, most will be bankrupt. It's like 80%. It's insane because it's hard. Okay. Out of the remaining companies, in another 10 years, most will be bankrupt because it's very hard. Out of the remaining companies, the absolute majority would be teeny-weeny companies like mom and pop shops. Out of the remaining, teeny-weeny will be huge companies, right? Because it's very hard. So, just the fact that company X, this company, reached sales of $31 billion, that is a big deal. It is very hard. Thus, would it be reasonable to assume that people working at the company are intelligent? Well, if a group of people achieved something that is very hard, they're probably intelligent. Right? I mean, reasonable assumption. Okay. Another piece of information. 5 years ago, this company had sales of just $7 billion. Right? So that's a growth rate of almost 50% per year. 50% per year is an astonishing rate of growth, especially at such a scale. If sales are growing this fast, would it be reasonable to assume that this group of intelligent people are very ambitious? Yes, it would be reasonable to assume. Now, would it be reasonable to assume that this group of intelligent, ambitious people will continue to develop? I would say yes, that is a reasonable assumption. Well, if they continue to grow this business, and in 5 years, let's say they double the sales, is it likely that the stock price will be higher? Yes. It's very simple. Okay? Okay. People get lost in the details, and it's actually hilarious, right? Now, in finance, in investing, huge amounts of money are in play. So, people can have a variety of intentions. Some selfish, maybe not intentionally, but human nature. Many industry professionals use very complex jargon to make it seem very complicated, and better you just leave them alone and keep paying those fees. How many times have we, the people, heard from the media about how hard it is to invest? How these large institutions with billions of dollars, an army of genius analysts working 80 hours a week, and their supercomputers, if barely they can beat the market and most can't, if most of these brilliant, rich institutions can't beat the market, who do you think you are? Well, on the surface, that train of thought may seem reasonable, but it is not. It is possible to beat the market, make more than just 8% per year. Now, this is, of course, just a hypothesis, and understandably, nobody cares what I think because I'm just a 25-year-old kid with barely 100 grand. But if I keep putting these videos out, let's say quarterly, right, and showing my performance, and many years pass, and I achieve returns which are significantly higher than the S&P, well, I suppose my credibility will go up, right? And this video will be here to show that I told you. I want to create these videos from a sense of collaboration, right? I am not afraid that if I put out my strategy, like I freely share my strategy for free, that people will steal the strategy and it will stop working. No. Just those 20 companies that I showed you have a combined market cap of over $5 trillion. Okay. If I were to go on national television and 1 million people would each invest $1 million this way, the strategy would still beat the market. Right? This is not some fucking chart pattern gimmick that can be arbitraged away by algorithms. This is fundamentally solid principles which should work for a long, long time. Okay? Okay. What needs to be remembered about the strategy is it's a long-term investing strategy, and the rules say to keep your money invested 100% all the time, which means when the stock market crashes, your portfolio will crash as well. So you can't be a little bitch who gets scared by volatility, right? But here's the thing about volatility. I'm gonna really dig into the details because I want to. A lot of people, even very intelligent people, still have repressed fear in them. Like the primitive part of our brains is still there. When we put our money into the market and it goes down a lot fast, right? It can trigger that panic, that fear of survival, right? You feel as if your survival is threatened. And that fear clouds your judgment. You do not think clearly anymore. Another thing, it is widely accepted in finance that the definition of risk is volatility. Personally, I think that's a crock of shit. I think risk should mean the probability of success of an investment, right? So let's take the case study of Tesla. And this is just my opinion. This is just the ramblings of a balding 25-year-old. Never mind me. Taking Tesla. Tesla has a culture of rapid innovation, right? And it's going up against the legacy car manufacturers, an industry which for a long time, many decades now, has been a mature industry, right? Not in exponential growth. So here comes Tesla. And the management really pushes the employees to constantly come up with new ideas, right? I heard this interview with Sandy Monroe, an expert in automotive, say that in the span of 4 months, he teared down 2 Tesla cars, Model Ys, and the heat pump, which is a device made to circulate efficiently the heat in the car. Just the heat pump had 13 changes in 4 months. That is astonishing. When he worked at Ford, he said he couldn't get approved 1 change a year, right? Plus, let's take another thing. Each year, there are these big studies asking graduating engineers of top schools, if you could go work anywhere, where would you want to go work? Lately, this past year, Tesla has been ranked number 1. And even in past years, it's been number 1 and 2, SpaceX and Tesla, right? the other car manufacturers are way down the list, right? So the argument a few years ago that, Volkswagen has billions of dollars to invest. If they want to they can crush Tesla. It's not just money that is required to build a successful business. If the best engineers are going to Tesla, it doesn't matter that Volkswagen has more cash to invest. They have inferior engineers. Plus, the entire culture is not made for rapid growth, right? But let's just take this simple competitive advantage that the best engineers want to go to Tesla. Okay. Like a month or two ago, Tesla dropped 40% in a few weeks. Okay, that's the stock price. Now, let me ask you, in that few weeks, did the desire of graduating engineers change of where do you want to go to work? No. They still want to go to work to Tesla. Okay, this absolutely fundamental aspect as a competitive advantage is unchanged, right? Or the rapid culture of innovation, or all the others, right, are unchanged, and the stock is down 40%, right? Why would that be risky? Why would that be a risky investment? It's not, right? That's my opinion, right? My opinion is that the likelihood that Tesla will be rapidly and continuously increasing their sales, the chance of that is very high. Thus, the chance that the stock price will be much higher 5-10 years from now is also very high. So if I invest in Tesla and plan to wait 10 years, and let's say it will be significantly higher, what the fuck do I care how volatile it is till then, right? It makes no sense, right? It makes sense if you understand that people have repressed fear and that gets triggered and then they cloud their judgment and so on. But that's my 2 cents. Next, number 7. I'm going to say whatever I want to say. Number 7. Most big companies don't grow fast. Most fast-growing companies are not big. Thus, a big company that's growing fast is a special one, right? AKA Tesla, or that list of 20. So a big company that's growing fast. As I said, probably highly intelligent and ambitious people work there. So that's where I want to put my money. Here's a curious experiment. Let me show you. All right, so we're back on FinViz. Again, go to Screener. Then click Index S&P 500. Fundamental. And by the way, in the S&P 500, there's not 500 companies, but 505, but whatever. Sales growth past 5 years. And let's say positive. Sales growth above 0. From 505 companies, now only 379. So 126 companies from the S&P 500 index have declining sales. What? The criteria for a company to be in the S&P 500 basically is that it has to be big, so like over 8 billion in market cap, and it needs to be profitable, right? But if we just look at these criteria, you can see Tesla was not included only until it was worth like hundreds of billions of dollars, because it was not profitable, because it was aggressively investing in the future, right? Just like Amazon was losing money for many, many years. right? This criteria is no good anymore. How profitable a company it is now, right? No, what matters in this age of, rapid technological innovation is how fast you're growing, right? How much are you investing in the future? If you're investing in the S&P 500, a quarter of your portfolio, like 126 companies, are declining, have declining sales. That's what you want. I hear these dumbass reasons for why you can't beat the market, such as looking back at the last 30 years, if we were to have missed just the 10 biggest updates in the S&P, your returns would have been, I don't know, like a fraction of what they normally have been, right? It's like saying you can't time the market, don't try to trade the S&P, right? So sell before a crash and then buy cheap and so on. As if that's the only way to beat the market. How about out of those 500 companies, you pick the ones which are not declining? Oh, what a concept. Okay? What the fuck? I don't know if these people don't know better or have ulterior motives. There are about $4 trillion invested in S&P 500 indices, which take an annual fee. Billions of dollars, many billions of dollars, whatever. Hey, it's pretty much steep. This is just my opinion, right? Don't listen to me. But the exponential fund, took that idea further, right? So not just sales growth above zero, sales growth above 25%. The reason 25%, this is like a nice round number, 25% is about a 10x in 10 years, right? About. I think 26% is it. Anyway, it's about a 10x in 10 years, right? Nice round number. And why would you need 500 companies? I mean, I understand don't put all your eggs in one basket. I understand some diversification. 20 companies, 30, 50, goddamn max. It's plenty, okay? Who needs 500 companies? Okay. Anyway, just my opinion, you know? Number 8. As I said, invest an equal amount in the biggest 20 companies, which have been growing their sales by over 25% per year for the last 5 years and rebalance regularly. Number 9, exit a stock when the company's sales growth slows down below 25% per year or drops out of the 20 biggest. So you check the list once a year and you update your portfolio accordingly. And number 10, once your portfolio is big enough, sell 1 to 5% of your portfolio to live on and then enjoy life, help others, and so on. Right. So it's very straightforward, right? Like the way I was able to put this together, right? First, I acquired a lot of knowledge. So I wrote a lot of books, went to seminars, and so on. And then I let go of many attachments, right? So, this idea comes from spirituality about this mistake of the mind of attaching your source of happiness to something external, right? So the mind says, when I get that, I'll be happy. If I don't have that, I'm not happy, right? And that thing could be anything, money, relationship, sex, status, whatever, right? But the fundamental belief behind this is the way I am now, it's not okay. I need to change something. So, through a process of letting go, I took all my goals in life and one by one I said, It's okay if this doesn't happen. It's okay if that doesn't happen, and so on. In the sense that, I am happy regardless. Until nothing was left. I was just, fully in the present, totally happy. Broke as shit, but, totally happy. So after you reach a total state of happiness, now what? Might as well do something. But if you don't want anything, or if you don't need anything, what do? I mean, you wake up in the morning, like you have energy. It would be pretty irresponsible just to like sit on the couch all day and wait for the day to end. I mean, that's irresponsible, right? Like, if you are given energy, you might as well do something. But the motivation completely changes, right? I don't go and chase money so I will one day be happy, or chase success and status and prestige and luxury. Just like, no. I came to the conclusion of just enjoy life and help others. I mean, it's pretty simple, right? If I am already happy, then there's no reason to make myself suffer, right? Like, intentionally sacrifice myself for something, because there's nothing to gain from sacrificing. I'm already happy, right? So I only do things which are a win-win situation, right? I don't really compromise. I find creative solutions that are win-win. And so far it worked out very well, you know? Like with investing, I give my money to these companies grow, and my money grows as well. So I pay more taxes, I spend more, I invest more, everybody wins. And now I'm sharing this strategy. So let me show you a spreadsheet. Okay, so again, disclaimer, I'm not a financial advisor. Nothing I say is financial advice. Blah, 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 do your own research. This is just entertainment. Now, again, a quick rundown of the strategy. By the way, this document you'll have the link in the description. So anyone can see the rules, my portfolio, my performance, all of it. Right? So again, the rules of the Exponential Fund. Invest 5% of your money in the 20 largest companies that have been growing their revenues by at least 25% per year for the last 5 years. Rebalance regularly. That is, if a stock went up a lot and now represents more than 5% of your portfolio, sell some of it to get it back down to 5%. Likewise, if another stock went down and represents less than 5%, buy more of it to get it up to 5%. Do this weekly. I mean, I do this weekly. Then, once a year, check back on the list of the 20 biggest companies to see if you need to replace some of your stocks with new ones, and possible variations that you can apply. So instead of the 20 biggest companies, you can invest in the top 5, top 10, top 50, whatever. You can choose to rebalance daily, weekly, monthly, quarterly, yearly. And this is an interesting one. Instead of putting an equal amount of money in each stock, you can split your money based on the market cap weight. So you sum up the market cap of all of the 20 companies, and on FinViz, you can, it shows the market cap, right? So you sum up the market cap, and at the moment of this writing is 5.6 trillion. Then calculate what percentage of the total represents the market cap of the biggest company. So in this case, Amazon is 27% of that. So you would put 27% of your money in Amazon, and you would not rebalance in this case. And the second biggest company, Facebook, is 14% of the total. So you would put 14% of your money in Facebook, and so on. Right? Once a year, check back on the list in case you need to replace some of your stocks in your portfolio. Yes. All right. And a few characteristics of the strategy, just for fun. So the expected compounded annual growth rate, CAGR, well, because the criteria is sales growth over 25% per year, I guess the returns should be above 25% per year. I mean, I only started applying the strategy last September, so it's been like just over 6 months, right? It's still a hypothesis, but I will be tracking this publicly. Next, volatility of the portfolio. It is high, right? So you can't be a little bitch. Just push through it. Okay. Cognitive load, low. That is, it's very easy to execute. I mean, literally, I explained this to my 9-year-old sister, and she understood. Okay, there's no need for Greek letters here. Time requirement, under 30 minutes a day to under 30 minutes a year. I mean, I even put a stopwatch to measure how long it takes me to rebalance. It's literally 6 minutes. Okay, so 6 minutes a day to maybe 10, 15 minutes a year. Depends on how often you want to rebalance, right? Now, the style, this is very important. It's 100% systematic, right? It's rules based. There's no need for personal judgment, right? The funny thing is, that's the only thing you could know about those 20 companies, that they're big and that the sales are growing fast, right? When I first put money in these companies, I didn't even know what some of these companies did, like what their product was, or who was the management, or what industry, like nothing. Nothing. If a company is big and it's growing fast, for me, that's enough. And I believe that it's truly enough to beat the market. But hey, we'll see. Capacity, high. So capacity means with a sum, how big can you execute the strategy? Like, what's the limit? So, using this approach, you can invest and probably beat the market with a sum significantly larger than the net worth of the richest person alive. This was my goal when I created this strategy, right? If a person has a positive intention, right? So in my case, I want to enjoy life and help others. Well, if I have more money, I can contribute more to society, right? I can invest more in great companies. I can donate more to charity. I can, spend more to put money back into the economy. I can pay more taxes. So everybody benefits. Well, now that I have removed the guilt of having a lot of money, I'm not stealing from anyone, right? The more money I have, the more everybody benefits. So why not aim absolutely as high as fucking possible? And I did, right? My goal is to one day become the richest person in the world. That's right, I said. It might take 50 years or 100 years. I don't fucking know. It might take a lot. I might die first. Who knows? But my goal is to keep increasing my net worth exponentially. And then we'll see. You know, I'm already happy. Margin requirements, none. So no leverage is required. Thus, the probability of losing all your money is infinitesimally low, right? I wouldn't say impossible, but it's extremely low, right? And very important, the last one, the chance that the strategy will stop working is low. because this is based on simple and robust principles, right? As I said, invest long term in big companies that grow fast. There will always be big companies that grow fast, even 100, 1,000 years from now, I guess. I don't know. If society, I don't know. But the point is, it is very robust, right? This is not some gimmicky chart pattern that can be arbitraged away by algorithms, right? So, as I said, my personal goal is to continuously increase my net worth, to enjoy life and help others, and check this out, a moonshot. So, I believe the rules of the S&P 500 are outdated. I believe if the S&P 500 committee or like whoever decides what the criteria are for the company to be included, if those criteria are changed to, instead of the company needing to be profitable, you drop that criteria and you instead put a criteria of sales growth rate, right? So let's say sales growth rate over the last 5 years, at least 10%, at least double digits. If the S&P 500 committee would do this, trillions of dollars would be invested in fast growing companies instead of these old, mature, even declining companies. Right? Now, I understand that nobody cares what I think right now because I don't have a public track record. I have a very small amount of money, but the idea is here. And let me ask you this. If I'm right in the sense that this strategy, the exponential fund, does offer returns significantly higher than the S&P 500, well, in time, as the years pass, my credibility will go up accordingly, right? I mean, if I have 10 years of a good track record of earning 25% per year, that would be pretty good credibility. If I had 20 years, 30 years, and so on, that would be an amazing moonshot to succeed in changing the definition of the market, literally changing the benchmark. Now, I understand that there may be a lot of resistance to change. So here's here's like a fun experiment. What will happen first? The S&P 500 committee will change its rules so companies must have fast sales growth rate, or will I become the richest person in the world? It's pretty funny to think about that, but we'll see. Next, so this is my portfolio. I mean, I think it's exactly what I showed you in that list. I have 5% of my money in each. Just a few days ago, I did the rebalancing. So Airbnb, Alibaba, Amazon, Broadcom, Charter, Cigna, Facebook, Infosys, JD, Mercado Libre, Netflix, Nvidia, Salesforce, C, ServiceNow, Shopify, Snapchat, Square, Tesla, and Uber. These are amazing companies. Goddamn. And performance. So in this first quarter, the S&P went up by 6% and my strategy went up by 2%. After all this talk, I have underperformed the market. Now, what did I say? Over the short term, the price of a stock is unpredictable, and over the long term, the price of the stock goes back to the financial performance of the company. So it is totally normal to have a few months where the exponential fund performs worse than the market. This is not conclusive evidence that my strategy is shit. We have too few data points. So I will track, each quarter, and then, the total yearly, and then year after year. I'm guessing by the end of the year, my strategy will be up more, but almost definitely after 2-3 years, it should be up way more. Okay. All right. So that is about it. This first episode was a bit longer. I wanted to really delve deep into explaining my strategy. My goal with making this public, what would be nice is if in a few years, let's say 3 years from now, my strategy significantly outperforms the market, and I can go to a large hedge fund and say, hey, I know how to invest. Will you give me some money to invest and give me a commission? No, and that way I can accelerate my returns. They could say, hey, you posted your strategy publicly, so we'll just copy you. Understandable. Then I'll just probably open my own fund to invest for others. Because even though I showed exactly what I do and anyone can copy, I'm not advising anyone to copy. This is not financial advice. Again, this is just my opinion. This is just entertainment. I am a clown. Anyway, even though I've explained everything, there are people in the world, I believe, who have some money to invest and would say, look, Richard, I see you know what you're doing. Can you just do it for me? And I'm like, sure, I'll just take 1% per year as a management fee. Sure. So I bet there's a bunch of people like that who, even though I've explained everything of how I do, they still want someone to manage their money, because they would also be buying my psychology, right? So if I execute the strategy, I will fucking execute and not deviate, right? Some people just don't want to stress, don't want to look at the account every day. They want to know it's in good hands. But yeah, I'll be posting quarterly. So my goal with this is not to be famous or anything. It's a labor of love, right? See you in 3 months.